And we're live now. All right. Hello. Welcome back to the Financial Advocacy Podcast. I'm your host, David Kinder, registered financial consultant, charter life underwriter, here with Mike Moffat, my co host, and we're absent one. Um, Go figure. Technology is so wonderful when it works. Uh,
Yeah,
hey, Kurt, we'll figure you out later. I don't know what happened there, but give your computer a restart. Maybe that'll work. I don't
you're
know.
always welcome to try to come back in. So,
Yeah, we'll figure it out. But we're gonna move forward with our planned topic, which is it is a common phrase, especially I heard this early on, which is when you're deciding whether to fund educational plans for your children or funding your own retirement, the phrase that often comes up the most is, well, you can't borrow for retirement. So I kind of want to go into a little bit about college planning. It's not something I lead with, but I actually have a blog article on this. So I'll reference it. It's a byproduct of the work we do. It's not necessarily the sole reason or ways that we work with people. Um, and just recently, in the Facebook group I've got, uh, it, someone was asking, "What do you guys think of using life insurance on children for college planning?" And quite frankly, I'm not a fan of that particular strategy. I don't think the account grows quickly enough to use a child's life policy to outright pay for expenses. It just it just can't grow enough. It's just not possible. It's not meant to do that. I think it's just not setting people up for success with that. Mike, I saw you shake your head, so I'm sure you've done your own analysis. What are your thoughts?
yeah, I mean, in reality, that wouldn't necessarily be the way I would do it either. I think if you're going to do it that way, you'd almost have to dump in enough money over the course of 10 years to basically pay for the college itself, or over however many years. So it's not really necessarily going to work for those purposes as much as it is for other purposes that we talk about. But I mean, if you want to dump a large amount of money in there and therefore get a nice death benefit out of it, or set your child up for his future in that way, that's fine. But to pay to I think that the account is going to grow to pay for some astronomical college expense. I don't think that will ever work. Like I said, unless you just dump so much money in it that you could put it a lot of other places too. So
Yeah, it's more of a holding tank rather than a growing account in that way. So no, I agree with you on that. And grows typically at double the rate of inflation in terms of college expenses, and I don't see life insurance for paying for those expenses being the right strategy for that. So no, I agree with you on that. Now, what I did want to show is because and this is a value discussion, and one thing that I've always been taught early on is that it's not necessarily up to us to tell people how to do all their planning. So, for example, do you value your children's education more than your retirement? And I got a survey here that was done about 10 years ago that was kind of eye opening. I mean, our job as planners, if we dare want to call ourselves that, is to help people achieve their goals. Well, for me, I'm going to lead with what I believe, and if you disagree, that's okay. We might not have to work together, and we're okay with that. But if a parent is trying to choose, should I fund my children's education or should I fund my retirement? I also think of being on an airplane, and of course, I've done a lot of travel, and especially recently. And what happens at the very beginning before the plane takes off? We get the safety instructions, right? And they say, when the mask comes down, you put it on yourself first, then your child. So I am of the opinion that we should take care of our own education first, but that's not necessarily what a lot of parents think. So I'm going to share my screen here real quick because this was kind of eye opening. I wrote this article, I forgot how long ago it was, but I stole it from Financial Advisor magazine. And this was a survey, a 2015 survey of 2,000 parents. And 53%, so that's a little bit more than half, said they would rather use their retirement savings to pay for college costs than have their kids take out student loans. And well, I could see wanting to try to protect your children from student loans. I can get that. Student loans have been astronomical. It's, very expensive and costly, but at the same time, you can borrow for college in many cases. You can't always borrow for retirement. What's the next one? 51% would be willing to get a second or part-time job. That's the parents getting a second job or a part-time job to help pay for education, not the child. Now, granted, I
Right.
know the college economy has drastically changed since, let's say, 30 years ago, or even longer than that, where students would get part-time jobs. They would actually pay for their education as they're earning. That's not realistic to, at least in terms of 4-year universities, and master's courses and things like that. What were you going to say, Mike? I heard something there.
No, nothing. Go ahead. Keep going.
Okay. 49% said that they would delay their retirement and work more years. Now, many times, depending on what the context is, if you were thinking I was going to retire at 62, but maybe I'll retire at 70 instead. Okay, I could see that for maximizing Social Security. I want to help someone maximize the resources they do have, but not necessarily because you self-sacrifice too much because of your children. That's my perspective. And then the fourth one here, this was really eye-opening. 79% said that they were saving something for their kids' college costs, but they were using the wrong accounts. And why do we say that they're using the wrong accounts? And that was, I think I put that in brackets there because the wrong accounts can lower your maximum financial aid opportunities. So we'll talk a little bit more about that. But generally, parents are very willing to self-sacrifice themselves. And mainly because I think of that phrase, which is you can't borrow for your retirement. So is that true? Can you borrow for your retirement? And the answer is yes and no.
Fair.
It depends, right?
Right.
So let's get into the education part, and then we'll get back into that question here. The education part is just like when we plan for retirement. One of the things that we specialize in is looking at how is your retirement cash flow being affected by the tax code, right? Tax code is very much top of mind when we're talking to people about their retirement because most people don't know how pernicious and how well, I'll put it this way, how evil the tax code is because you were successful in doing what you're trying to do. You saved enough money. You did what the system told you to do. And now you're going to pay the highest amount of taxes that you've ever had in your life. And in a way, the FAFSA, the free application for federal student aid, works very similarly. The FAFSA, it's a federal form. And federal form, especially for public universities, and then you also have, if you're applying for private universities, they have their own forms, but they look at all of your assets to figure out what it is called the EFC, expected family contribution, and that primarily includes your income, whatever that income limit is or the income amount is, and then it factors in all of your assets. But there's 3 major asset types that are not required to be disclosed on these forms. And actually, there's a 4th for private universities. It's my understanding. So the main 3 are retirement accounts. That's your 401k, IRAs, 403b, SEP, Simple SEP, SARSEP, all that stuff, 457 plans. None of that has to be disclosed on a FAFSA form to determine financial aid eligibility, which is a beautiful thing. Maximize those opportunities. The other 2 are life insurance and annuities. Neither of those of their actual cash values have to be reported on your FAFSA. And so when I'm looking at college financial planning, what a lot of insurance agents may do, and I'm not saying that they're doing this badly or with a bad intent. I just don't see their perspective because I think that if they're leading with let's shelter as much money as we can into these contracts, which is I'm all for it. But if you're doing it just to maximize your college financial aid, that's too short-sighted. It really should be that you're planning for your retirement. Your retirement structure is foremost, more important. And then you actually happen to get all the benefits of having life insurance and annuities and all those other things. So that's my thought. And before I forget, the fourth area that may or may not have to be disclosed is your home equity. Home equity, I believe, is required for disclosure for private universities. Public, not so much. So all these areas all combine to figure out your expected family contribution and how much you get to pay as a parent when your children decide to go to college and university. Ain't that fun? And so that's why, with all of that calculation, we look at those survey results, and this is why parents are, I think they may feel like they really want to get their child started off in life the best way possible, which that's a great intention. I just don't want to see a parent be sabotaging themselves long term for having done so. So,
yeah, I mean, another thing is that a lot of times kids are opting to not even go to college anymore. So if you have something set up and they decide that they don't want to go, or something else happens, you may be stuck with an account that you can't use, depending on where you put the money.
Exactly. And one of the most common places that if a consumer goes to see a financial advisor and they say, I want to help my children save money for my children's college education, they're more than likely going to put them into what's known as a 529 plan.
Right.
And 529 plans have a lot of, with my understanding now, I used to think there was a lot of great benefits there and then a little bit of drawback. Now it's kind of opposite based on my new perspective here.
I
let's
agree.
go through. Yeah, so it all depends on where we're coming from. But let's start with the positive parts, generally speaking. And 529 plans are state-sponsored plans, but you don't have to invest in your state plan. So, for example, here in California, there is no additional benefit for choosing the California 529 plan over any other state's plan. Because if there was an advantage, you'd invest it into the 529 California plan. I forgot who even does that. I think it's USAA or some TIAA-CREF. I can't remember the company's name now. But you would get a state tax deduction for putting money into that plan if you're resident of the same state. California doesn't have that. And so when I was doing 529 plans, I was doing the Virginia plan, which was done by American Funds. And different states have different mutual fund companies. Typically, they're mutual fund companies. Some might be a CD or something. I can't remember right now. But you have different investment options and things like that. But what's interesting about 529 plans is that as you grow the account, the money has to be used for higher education purposes. And if not, whatever the growth is, especially because if you can't deduct it, we're taxed on the growth.
Right.
The growth will be subject to income taxation and a penalty, 10% penalty on the growth. I remember it making big news. I think it was 2 or 3 years ago. I can't remember exactly when, but 529 plans. You can now use your 529 plan to buy your kid a computer. I'm like, thank you so much, federal government, for letting me figure out how to spend my money that I set aside for what you deem to be as eligible educational expenses. Thank you so much for your permission. Really?
Wild, isn't it?
Yeah. And granted, now they had to do it while computers are at some of their lowest costs possible. Now, I mean, I don't spend a fortune on my computers. I get older computers off of eBay. I spent $250 on a Dell Precision i7, 16 gigs of RAM, 32 gigs of RAM. And now I have a 1 terabyte SSD in there. This thing's amazing. It was made in 2017, and it kicks butt over most new PCs today. But I'm like, I look at them like, if I had built up, let's say $250,000 in a 529 plan, thank you so much for letting me deduct $250 for a computer. I mean, come on. It's just, it makes no sense to me anymore. But what's even more interesting is the ownership requirements of a 529 plan to make sure that the account itself does not take away some of your financial aid eligibility.
Right.
So if the account was owned by the child, I think it's included up to 25% of that asset is included in the FAFSA.
That sounds right.
And then I think if it's owned by the parent, I think it's 10%. I wrote down these numbers somewhere, so I might have to re-verify. But they're included in the financial advocacy. No, excuse me, they're included in the financial calculation for the expected family contribution. So the best way to utilize a 529 plan is have the grandparent own it, set up for the grandchild. And this way, it doesn't show up anywhere on a FAFSA. And this way, it helps you to maximize your financial aid eligibility by just taking it off the radar screen of the FAFSA. I keep saying in the group, we just keep saying the radar screen of the IRS. Now we're talking about the radar screen of the FAFSA. Anything we could do to help maximize anything.
Get it off the radar screen of any government authority.
There we go. And we might have to take you off the grid too. I don't know. We're not doing that. But,
I hope not.
But there's all these things here that they have triggering events and ripple effects depending on where you're putting your money.
Well, and even still, even if the grandparents are doing it, they're still going to be stuck with it if the grandchildren decide to not go to college. And then they're,
right. Although there are some options there. So let's suppose grandparents typically have more than one grandchild. Typically.
Sure. You would think.
So you can always change the beneficiary from one grandchild to another. No problem. If the grandparent wanted to, there are some people like this, and I know them. There's some that like going back to school. So maybe the grandparent could use it for themselves to go back to school in retirement and do study for whatever they want to do. Whatever. I mean, I'm not here to judge. That sounds great to me. I mean, it's a great way to, stay active and
sure. Yeah. There's even a lot of community colleges that offer programs for retirees and stuff like that, where they can go back and get, education on things.
Absolutely. So that's another possible use for the funds without paying a penalty, as long as that's something that you'd actually would want to do anyway, right? I don't want to say go back to school to avoid paying a penalty. No. Don't necessarily let the tax code wag the horse or wag the tail here, because I want you to enjoy your life, not just make decisions only because of the tax code. But if we can consult the tax code and figure out how to maximize your enjoyment of your money and get some of this government interference out, by all means, we're all for that. So it depends on how you want to do it. But worst case scenario, you liquidate it out, you take out the funds, you pay the penalty on the growth, and you're set. And then you put it wherever you want to. But I'm all for the idea of, can we just not even worry about, or how can we lower the expected family contribution to be as low as possible based on where your assets are at? Can't do a whole lot regarding your income. Your income is your income. Whatever it's taxable at is taxable. Can't do anything about that. Yes, you can make, and by the way, some people might say, well, I'll just maximize my 401k contribution. Or if they're a business owner, I'll make a contribution to a pension plan because those have far higher contribution amounts. The question becomes, is the next year, are you taking money out of these plans to pay for college? Because then that money comes right back onto your tax form, which means that it negated everything. So your deduction became a distribution. So it really depends on how you're using these accounts. So there's a number of things in there regarding financial planning for education purposes. My purpose would be, let's get as much of your assets off the radar screen of the FAFSA as possible. Let's make sure that you're not taking distributions against these accounts, because the 529 plan, you'd want to take a distribution. You take a distribution against a life insurance policy, for example, meaning you do a loan against a policy. That's a loan. That's not a cash distribution. That's not taxable. So you can really maximize your opportunities there. It's not income. Exactly. Yeah. I hate to see the day when loans become income, which would collapse the economy. I don't think that day will ever realistically come.
Or become taxable, just in general. Not even if they just find a way to tax loans, instead of counting it as income, they just tax it. That would be disastrous too, because then who's going to want to get a loan?
Yeah, exactly. And imagine if these student loans were taxable upon receipt. Now, what'll happen if they're taxable? Would tuition go down to meet the taxable amount? I don't know. There's a whole ripple effect there. I didn't want to examine that.
Yeah, that would really screw everything up, and it would make it a whole different ball game. And you could go down probably 1,000 different rabbit trails trying to figure out what would happen, if something like that actually occurred.
Yeah, exactly. So let's get back to the original thing. Is it a myth or a fact that you can't borrow money for retirement? And I did say yes and no. So let's talk about that. The myth is that you cannot borrow unsecured for retirement income. So, but you can borrow secured or using collateral to back a loan that you could then use for whatever purposes you want. And my mind was open to this the first time. This, like, how long ago? This would have been, I don't know, 18 years ago or so. And I'm first learning about reverse mortgages. And the reverse mortgage was the first time I'd ever heard that you can borrow money for your retirement. You can eliminate the mortgage payment on your property, and as long as the borrowers are eligible and your loans to value make it eligible, you don't have to make any more payments. So I'm thinking, okay, so it eliminates the cash flow outflow to making a mortgage payment, and then you can actually retire on less, which means your portfolio is secured for a longer period of time because you don't have to draw down as much. That's an interesting idea. And then if you actually have a more available home equity in the property, or you've paid it down more, you have more available that you can draw against. So I thought there's some interesting ideas there. So you can borrow for retirement, and it can either be a line of credit or you turn it into a new. There's many different payout factors on that. I am not an expert on all of those. One thing that is interesting, and I'll bring this up, is that for the amount that's eligible for reverse mortgage. So let's suppose you have less than 50% of your loans to the value of the property. Whatever isn't borrowed could grow at a stated interest rate regardless of the value of your property, which means that it's the amount that's unborrowed. So let's suppose you have $100,000 of equity and it's unborrowed, you're not touching it. That amount can grow by a stated amount each and every year. Let's say for 20 years. You could have 200,000 or 300,000 to borrow against over time. Of course, you have to stay in the property. You have to keep your property insured, so you're not out of your homeowner's insurance or your property taxes. You got to take care of your property, but that could grow into a future resource that you can draw against for other expenses. For example, home health care. If you cannot take care of yourself, that money could be used for that. It could be used for taking trips. Now, granted, you have to be 62, a minimum of age 62 and older to do this. So if you're waiting 20 years, you're going to be 82. Now, 82 is probably the new 62. People are, as they aging, are not quite as old as they once were. But do you really want to wait that long to take that trip? I'm not sure. So, but there's versatility in that kind of planning where possible. So a home equity is just one area, and you could do it in a couple ways. You might not even be doing a reverse mortgage. You can refinance it into a new first mortgage. And if you refinance to a first mortgage, of course, you're reassessing your property values and such, depending which state you're in. There's other consequences there. But that's another way. But of course, you're subject to a new repayment agreement, right? You got to make payments on it. How else could we borrow? If you have commercial property, so you own a business. Granted, you still have to be in business, so I'm not sure if you can really do a commercial loan against a business property without actually running a business. So I don't know, but it's another way to use collateral to put money in your pocket, but again, subject to repayment. The fourth one, which is probably it's Senator Warren's favorite one to harp on. And Senator Warren loves to talk about the fact that Jeff Bezos doesn't pay enough income taxes. He's one of the richest men in America or in the world, and yet he doesn't pay enough taxes because he just borrows against the value of his companies. And when you borrow, it's not income. Therefore, he's not paying taxes. And whether you agree with that or not, I think it's a smart tax strategy. Being able to borrow against eligible securities is a beautiful strategy to use if you have the means built up. This is why I say yes and no. You can borrow against your assets, but you have to have the assets first.
Right. So, and it's kind of the same thing like what Musk did when he bought Twitter.
Yep. Go ahead. Talk more about that.
No, that's all. He used collateral to purchase Twitter, and so once when he did that, he didn't have any taxes due on any of the any of the money. So yeah, again, he had to have the assets to do that. But it is a way, if you do have the assets, to be able to use them to avoid taxation and to grow things and to have other assets that you can build on. But and my dogs are barking, but so I didn't get to really comment on your reverse mortgage thing. But yeah, reverse mortgages are a great way also of accessing money or collateral in retirement. And in most cases, the kids don't want the house. So
Yes.
if they're going to sell it anyway, and you have all of this equity in your home, why not use that equity while you're alive? Especially, if maybe finances are difficult, in other areas, when you have, and there's no coupon book, there's no repayment plan, as long as you stay in the home, you don't have to, ever pay the loan back. And in theory, right, real estate keeps appreciating. So, in theory, you should be able to pay the loan off once you pass away, or your kids want to take the house and still have some money, in the house. And plus, you can only borrow up to a certain value of it. I forget all the rules and things like that, but you can only borrow so much of it out. They're not going to give you like 100% or 120% or some number, loan to value on your house. You can only, collateralize so much of it, because obviously the bank wants to be able to make sure that they're not borrowing more than your house is worth in case you happen to pass away early or something and you need to sell the house and you need to get their money back. So I think a lot reverse mortgages were poo-pooed on kind of for a while as a bad thing. And I agree in a certain, to a certain extent, there can be some predatory lending that has gone on with that kind of stuff, and people taking advantage of not understanding how it works. But for the most part, as long as you understand how it works and what's going on with it, and you're doing it with a reputable lender, things like that, a reverse mortgage is a great way to have lots of working capital with no repayment plan when you're retired and you need access to cash.
Yeah, and I think way back in the day, and my thoughts of this are fuzzy at best. So, but back in the day, I think you had to pay a lot of fees, and they had to be out of pocket at the time. And we're looking at
that sounds
maybe
right.
$20,000 out of, and it had to be out of pocket. Now, I think you could do much of the same thing, and yet it could be rolled into the new mortgage. So it's charged up front against whatever available loans to value you might have, whatever equity that's eligible for it. So I remember that being kind of an issue, and because of all the fees and everything, I think that was the idea. But if you were to pay $20,000, and this is, we're looking back, 15 years or so, and you're able to get access to 250, wouldn't that be a pretty decent trade-off? And logically thinking, I think it would. So anyway, I think it was the fees that came under concern. And I remember FINRA had put out their advisory bulletin, and now they've revised it. They're just saying approach them with caution now, which that's good for anything. I do have a local reverse mortgage guy and mortgage guy in general here. Maybe we'll have him on. You've got a mortgage guy that you've got as well. I don't know if he does reverse mortgages.
I'll have to see
more on this.
Yeah, we'll look back to this, but I'll ask him, make sure. I'm not sure if he's currently doing reverse mortgages. I know when I was working with him a while ago, this was a decade ago, probably now, they were doing reverse mortgages then, but I think very few lenders actually do them anymore. So I'm not sure if the lender the broker or whatever that he works for currently does them or not. But
if they're still active in it, we're not finding many of the household names doing them anymore. So like, I remember, Bank of America was big in it. Wells Fargo might have been big in it. MetLife, they have a mortgage division. I don't know if they're doing that. Or Mutual of Omaha. I think they either did. They might still be. I'm not sure. But there's a lot of companies that do them, but they're not necessarily the biggest household names. That's not a bad thing. You don't really care where the money's coming from as long as all the terms are disclosed and everything's all fine. But yeah, so reverse mortgage, one of my favorite things as needed. It can be a strategic option if we plan for it in advance. Being able to borrow against eligible securities. And here's the thing, though, everything we talked about, we're not talking about being able to borrow against your qualified retirement plans because you cannot borrow against those. That's probably the biggest asset that most people have is their IRAs, 401k plans. And by the way, a loan from a 401k plan, you have to stay working for them to get a loan from them.
Mm-hmm.
You cannot take a loan against a 401k plan that you don't work for anymore. Because the repayment comes out of your salary. It comes out of your paycheck to pay it back. So if you can't repay that out of salary because you don't work for them, you cannot get a loan. Not to mention, here's the interesting part. You're borrowing the money out tax-free because they don't tax you on the loan coming out, but you're paying it back with after-tax dollars so that in retirement, you're pulling that money back out to pay taxes again because you already paid on it when you were repaying it.
Right.
It's an interesting thing there, but yet better to have money than not need it. I'd rather see someone have a 401k plan and be able to use it as they need to. It's just interesting with all the government restrictions and regulations that surround these plans. But yeah, you can borrow for retirement. And of course, our favorite strategy is using a life insurance policy, but it's not just any policy. There's a lot of different policies out there. Most of them may not be the best to use this for. Our first episode, we talked about one particular type of policy, and we're not necessarily the biggest fans, but it could be used. I just don't think it's the best.
Yeah, I mean, well, not to get back into that whole wormhole, but there's a lot of issues with it. And we may even have to talk about that again at some point because it is an interesting tool to use. There's so many moving parts and so many things that can go wrong, especially in the structuring of it and how it's set up and how, I mean, there's too many variables, I guess you could say, for it to work correctly. I mean, if you're just using it for even just the death benefit, I guess that'd be okay. But, in that case, you'd probably be able to find 100 other policies that would pay more death benefit. So,
could be, and they're different. So if I was to use an index universal life policy primarily for death benefit, I'd probably be looking at it for the lowest price of the non-lapse guaranteed premium. And I'm sorry, I'm going into agent speak here. It's like, what the hell did I just say? I get it. But what you're going to do is you're going to guarantee a death benefit as long as you pay the premium every year, as long as it is a guaranteed premium. And if it's not guaranteed, then you might have some issues down the line. But I like that idea where you have a death benefit that will be paid off as long as the minimum premiums are paid. Then this is the fun part, you can leverage all your other assets against that death benefit. So if you have a 401k plan, you have an IRA, you have a Roth IRA, you've got your reverse mortgage and whatever else, you can borrow or withdraw those assets and then have that death benefit restore those values upon the first passing of that person.
Yeah, so there are uses for it for sure, and in the right situation, it can work. As far as for the strategy that we typically implement, I don't think it'll work, during the distribution phase.
Yeah, there's a number of parts that we have concerns on. It's not impossible, but there are concerns, and usually the agent is the deciding factor on that. Unfortunately, I have to say it like that. We can't just say, have this policy, it's going to be great. No, it's the agent that comes behind the policy that makes it work or not work. It's
funny. I was on a TikTok live watching these IUL agents talk that hey, IUL, and they, and I will say that this is the agent's fault. I went in and checked myself and how the policy was structured for the age of the client and the amount of money they were funding in to the death benefit and stuff like that, for this tax-free retirement, from an IUL that all these TikTok people talk about. And they had 3 times more death benefit than they should have had for the cash value to be accumulating properly. No wonder the thing is failing.
Yeah.
I mean, it was unbelievable. I was like, well, yeah, I mean, that's never going to work. You know, they're funding it 3 times, you know, what the minimum that they should be funding it to make the thing do what the agent claimed it was going to do. So the agent, like you said, definitely does, and their understanding of it. And I think a lot of agents aren't necessarily doing this on purpose. They just haven't been trained the right way. And they're just told, hey, you know, this is a product where you can sell it to somebody and they're going to have a tax-free retirement or whatever they're going to claim. And, you know, they can use the cash in it to borrow against. But in reality, if it's not set up the proper way, they may not even have cash at all in the thing for 7 to 10 years. Right? Or if they do, you know, it's so little that you won't even be able to borrow against it. So if you're going to use an IUL, having an agent that understands how it works and how to structure it properly is a huge part of the game. And so if I was going to go that way, I would maybe talk to 2 or 3 different agents at least, or look at 2 or 3 different companies and see what their, you know, history is as far as their indexing rates and how the agent structures the policy and how well they know how this thing works. Because having an agent that understands how to do it correctly versus just having an agent that's been told that you can use this, or even a newly licensed agent that is all excited about it. And, you know, while that's not a bad thing, you know, there's a big difference there. I mean, I feel bad for these people because, you know, the lady was told she was going to have all this cash, and in reality, the agent screwed the whole thing up, you know, doing 3 times the death benefit they needed to for cash accumulation. It's just, you know, so when I hear these people talk and they say, oh, well, there's no such thing as a properly structured one. Well, that's not true. There is such a thing as a properly structured one, but the agent a lot of times is either uneducated or, you know, I don't want to say it, hopefully not, but they're just looking, you know, for the commission. But yeah, I mean, either one is a possibility, but in the right situation in IUL, it can work in theory.
Yeah, there's the moving parts. Completely agree. Because here's the thing: I know who's watching us here, and I know my buddy Alonzo. Hey, shout out to you, my friend. You know, he's very partial to IUL, which I'm all for it, and he knows how these things work. And of course, he's an advocate of ours. And Rael, my friend, salute to you, and Prince, salute to you.
What's going on,
you guys? You guys are using IUL, and I'm okay with you guys because I know you guys are being taught properly. So I'm always cautious because the industry at large, unfortunately, does not always do justice for the product and for the consumer. Unfortunately, I wish that was not the case. It is what it is. Our goal is how can we set up our clients for success each and every time, and unfortunately, sometimes it's not necessarily the product choice, but it is always about the agent that's giving the advice. It's one of the reasons why we're talking about this stuff, just to show you that there's a lot of factors that we're thinking about when we're putting these things together. So I think I've pretty much covered everything. I covered the EFC. We talked about you can borrow for retirement, but you have to have your own assets first to be able to borrow.
Well, even if you're not borrowing, you still have to have the assets, right? Even if it would pull down from a 401k or a Roth or anything, you still have to have the assets to retire, no matter where they are, right?
It was about 3 years ago or so. I was in a singles Facebook group, and I offered to do a class, and someone said, "Look, they're in their early 50s. They're starting over in life. Their spouse never saved a penny. How can they plan for a successful retirement?" And I'm like, wow, that there's a lot of work that needs to be done there. But my thought would be buy a house. And strangely enough, I don't always say this, but pay off that house so that you can eliminate the payment and even borrow against it for income. You're going to be contributing to your Social Security. Between those 2 things, you're probably going to be pretty good for where you're at now. Then you can build up other assets and things as you go. But right now, you get a house, pay it off, reverse mortgage.
There you
combine that with Social Security. That's pretty good. For
Yeah,
someone just
and
starting off late in life that has almost nothing.
and if you can contribute to a Roth, even max fund a Roth on top of that for, the next 15, 17 years until you retire, you should have a decent amount of money in that Roth. Hopefully, the market does well, hopefully. And, so between the house, the Roth, the, Social Security and all three things, it can still work. And I think it's unfortunate. There's, a lot of people talk about, just, put $100 a month into this fund and you're going to retire with $10 million and But, I mean, that's all you hear about from these Primerica people is, if you just put $100 a month into Dave Ramsey's, skyrocket fund, you're going to have $10 million by the time you turn 65, right? I mean, it's just ridiculous, but here's the thing. First off, nobody does that on a consistent basis. And second off, it's surprising how many people in their 50s or 60s or even late 40s have virtually nothing saved for retirement. And it's more common than I think it's more common than most people want to admit or realize, is that people have very little or almost nothing compared to what they should have saved for retirement. I think that that's more common than many people would like to admit.
What I hope is going on, because I haven't been in that world for quite a while, but companies, and we talked about this when we talked about the Dave Ramsey 12% mutual fund, which is that you can actually get started contributing to an account with like $25 a month. They have some of the lowest, they call it a PIP, periodic investment program, that you can contribute to regularly. And I'm hoping that it's not being said, hey, do this and that's all you need to do, rather than it should be, let's get started with doing something. Isn't something better than nothing? We'll increase your contribution over time. And I'm great with that for mutual fund contributions and to other types of accounts that way. I am not okay with that for life insurance. Other than you can start with term and then let's get you into a max funded policy later. I'm okay with that. But the horror stories I hear is, let's start you off with this IUL policy for $100 a month. Can we increase it in a couple of years? Okay. And then no one comes back to help them increase it, and the costs bury the policy, and it becomes a problem.
Yeah, everything. If you're only doing $100 a month, that's not going to work in an IUL. Yeah. It's just not. It's not enough money. The cost of insurance, even at a max, properly structured, max funded one, the cost of insurance will still be eating away at it a little bit. And if the indexes don't do very well, yeah, I mean, $100 a month into an IUL, that's you're doing that person a disservice. It's never going to work, and it'll destroy itself on the distribution side. So, yeah, I mean, in that case, yeah, you want some kind of, mutual fund or a Roth or something like that. Putting a Roth into a fund or something, and hoping and praying that you get Dave Ramsey's 12% every year for the next 10 years, and.
There's worse things. That fund was a good fund. I wouldn't necessarily stay in there for retirement purposes, but it was a good fund. So everything is, of course, and I swear, I got to get a shirt that says this. I've got to get a shirt that says, it depends, right? Everything depends. And there's one of the missions of this entire podcast is to be able to say that every situation is going to be different. Every person is going to be different. We're trying to advocate to help you make the best decisions possible for you. And anybody that just has pure rules of thumb is lazy with their advice. And if we can help people make clear decisions that make sense for them, we could be their advocate, helping them make good decisions. And of course, what we want is loyal clients long-term, that not only we can take care of, but that they will introduce us to others and we can help take care of them, just the same way as we took care of them with the original advice. And then, of course, making adjustments as we go. That's the whole point. That's the mission of it. There's one other area of borrowing that I didn't really talk about. I talked about it for a commercial mortgage, but if you have a business and your business is profitable and you've got pretty good records on things, banks will lend to you based on the value of a business. And there could be some interesting strategic ideas there. That's beyond the purpose of this podcast. But I'm just saying that there's other opportunities that, depending on how we want to harness them and use them, there's some amazing stuff that's out there. Anyway, I think I've covered everything I planned to cover. Yeah,
Yeah,
I covered
no,
it.
I think
What
this
are your
was
thoughts there, Mike?
no, I think we can wrap it up here. But this was pretty good episode, I guess you can call it. And there's a lot of alternatives and a lot of things out there that sometimes people don't think of that they can use for their retirement. The reverse mortgage is a great one. Of course, you have to have equity in your house to be able to do it, and things like. And there's some other stipulations of things that you have to go through and what have you for you to be able to get a reverse mortgage. But it is one route of untaxed income, so to speak, that you can definitely use to enhance your retirement, and it doesn't affect any of your other things because it's a loan. So it doesn't affect your Social Security. It doesn't affect your Medicare Part D IRMA or Part B IRMA or any of those other things because it's a loan. It's not income. So there's all kinds of benefits to it. Again, keep in mind that it is still a loan, and the loan will have to be repaid when you die. Now, here's the interesting thing: is if the real estate market does collapse, and the house does go down in value when you get a loan on the house, heck, the bank could be on the hook for it.
Let the bank be on the hook. They can't do any. I can't. It's not a recall, but recourse.
Yeah.
There's no recourse on these while you're still alive and living in that home. It's when you want to leave or once you, and quite frankly, if you pass away in the home, the bank's on the hook.
Right.
And by the way, if you're thinking that your kids want to inherit, I didn't mention this, but let's get.
I touched on it earlier.
I know you touched on that, but I want to get a little graphic. Your kids don't want to have marital relations in the same bedroom that they were probably conceived in. I'm just throwing that out there. If you're ever thinking that your kids want to inherit the home. Now, unless you're in a great part of town, look, if my parents still had that house in Irvine, yeah, I'd probably want it. But I believe me, I would be trying to gut that thing and make it very different so it didn't feel like my childhood home. I'm just saying changes would have to be made. It's not going to be preserved in the same way for all posterity. They don't want that. I had to go there. Okay. I think on that note, we better wrap this up. Otherwise, I'm going to get more interesting.
Yeah. All right. Well, we'll see everybody next week. We hope you guys had a good 4th of July yesterday, and everybody stayed safe, of course. And don't forget to like, share, subscribe the podcast. We're trying to grow this thing, and would like to get the word out. So hopefully you can do that for us and pass it along. And yeah, we appreciate everybody that tunes in and watches, and hope that you can join us every week, and we can help you guys out. And we are here and we exist to help and inform the consumer. We want to make sure that everybody understands their options, in retirement and investing and different things. So feel free to share and like and subscribe. That would be very helpful.
Perfect. And go to our website, financialadvocacypodcast.com. You can read a little bit more about us. You can go to our own individual separate web pages, and you can get down rabbit holes that way. Thanks for mentioning that, Mike, because I'm terrible at mentioning those things. I just stay on topic. I forget to promote. So yeah, like, share, subscribe, and comment, and we'll get back to everybody. We'll see you all next week, same bat time, same bat channel. See you then. Thanks for tuning in.
See ya.